Right. Good morning, or good afternoon, or good evening to everyone who's joined us, and thank you for coming through for Afriforesight's webinar today, in which we will be assessing the recent rally and potential for sustained recovery in the PGM sector after a brief overview of our global economic outlook. My name is Nathan Masson. I'm Afriforesight's chief economist. And just briefly for newcomers to this forum, we are the largest mining research house in Africa with a multidisciplinary team ranging from economists to engineers, and our work focuses on providing forecasts for Africa's key extracted commodities and the major cost items associated with mining and processing said minerals. Although we will be brief in the time allotted today, we will try to cover as much as possible in terms of data provision and the general topics under focus. And all of this information that we show in the webinar, and as well as further details, are included in our various reports, which are available to the subscribing clients. If you're not a client or do not have access to any particular aspects you might see along the way today, you're more than welcome to contact Sebastian Naidu, our our business development executive, or Kiriti Marti, our client servicing manager, using the details on screen. We will also be answering questions live at the end of the formal presentation of about a half an hour or so. And please submit your questions through the Q&A function of Teams itself, either at the top or bottom of your screen. However things are set up, you should see a button with the Q&A, which opens effectively a little chat window where you can put your questions for us to address later on. If you have to step out, you need to leave early. There's no problem there. Or if you think of a question later down the line, you're more than welcome to send the email through to what you see on screen, or either of any of the researchers that are going to be chatting today. And lastly, a recording of this webinar will be provided on our website from later this week, or can be provided as a copy to clients on request as needed. So, to start us off, we're going to look very briefly at how the global economy has progressed coming into this year, how our outlook has evolved, and how we're going to be looking at the next couple of years as far as the prospects for growth. So, a lot of attention has come through from the potential for slowing down of global growth, mostly centered around how things have shifted for the view on the US as the new administration took hold. Previously we were already concerned about the conflict zones and China's slowing activity, mostly driven by their fallout in the property sector, as well as what was already happening in Western Europe. But the push from the US towards what we economists call protectionist policies that come through in the form of these tariffs or trade barriers that have very much been coming through not only from the US, but have been increasingly being used in the global economy, is definitely weighing down a lot on sentiment and holding back certain exporting countries. Particularly, we're seeing that directly in the data from China, as well as holding back investment sentiment in the US itself, as the prospects for the US are undermined, and the whole world in general, really, by all of these additional constraints as the US tries to bring some more manufacturing capabilities to its own shore, or get a bit more control over the global financial situation that is unfolding right now. So in the context of this, we have downgraded our global growth view into this year. We had already expected a bit of a slowdown, and we've now made that more severe, given how we do expect a genuine slowdown in how the growth rate in the US is progressing. And in a few moments, I will touch on how we see a bit of stabilization, a little bit of recovery, even if it remains below trend. But all these near-term factors and these uncertainties are driving a very strong push in the world and in the financial markets to what are called safe havens. Very often you will hear that gold is a hedge against risk, certainly in the financial spheres, but even just in the context of a conflict. If a system breaks down, maybe your currency is not quite as valuable or as efficiently usable as it previously was. Gold is a readily tradable commodity, and given the extremely heightened uncertainty that we've seen in the world in recent years, gold has shot out to absolute record highs, touching over $3,500 earlier this year, and has maintained a very high level. Just to quickly explain this graph, it's a little bit complicated, and to try to compare the various prices involved required that I indexed everything to the beginning of the year, so we can actually see how these prices have trended against one another relative to where they started at the beginning of the year. So just to quickly give a bit of an example, where the the dollar was at the beginning of last year, and I've also inverted this dollar index to show that or to just give a little bit more sense that as we see the dollar weakening, you might pick up in our other publications, we often talk about as the dollar weakens, prices rise. And there's a couple of mechanisms where this goes through, but as other currencies gain strength, they can then have a better purchase on being able to take those commodities themselves, and the intrinsic lower value of the dollar means that you would have to put down more dollars to pay for any particular amount of gold now than you would have at the beginning of the year. And that weakening that you see in the dollar, if you're looking at a dollar-based price, typically comes through quite directly, especially in well-traded metals like gold and silver and platinum. So the fact that we've seen this generalized weakening trend of the dollar, to quite a large extent, this is about a 10% decline since the beginning of the year. That should also translate directly into about a 10% increase in the price of all of these various metals and commodities in general if they're traded in dollars. So as far as we're concerned, around about half, maybe 40% only of what we've seen in terms of the rise of gold and silver this year so far has been because of how weak the dollar is. But the trend in platinum here in blue is clearly surging ahead of the other metals and the currency in general, implying there's a few other factors pushing into the platinum market itself. Now, the safe haven appeal is also something that translates into platinum. It is considered a precious metal alongside silver. They're not quite as attractive in a sense as gold, but because the gold price is just so high, we've actually seen a significant shift over to platinum and silver and other reserve currencies as they're known. The dollar is actually one. The dollar is a safe haven asset in a way because of how well it's used in the world, how easily tradable it is in the world. But given how the sentiment around the US and the prospects for the US economy under the current administration have been undermined by their fairly aggressive trade policies, we've seen a shift away from the dollar and a move towards more smaller precious metals. As you can see, this synchronized upswing in platinum and silver here in the early part of June was also accompanied by quite a sharp pickup in the yen and the Swiss franc and even the euro as people turned away from the dollar at the time. But returning to the point I had where we've seen this platinum price shoot out above trend, beyond the weakness of the dollar and this increase in safe haven demand, that level of the gold price has also pushed some substitution in the jewellery market away from gold, which is now so costly that the relatively inexpensive platinum, which is maybe 35%, 40% of the price of gold right now, is comparatively good in the Chinese market, maybe a little bit in India. That's certainly come through to boost that element of platinum demand, which is maybe around 20% these days. And we've had a pretty significant shift in sentiment around the auto sector, which is actually still the main driver of overall platinum demand. But if we take a step back and look beyond all these uncertainties and near-term issues, and look at how the data, the macro data has been trending over time, we are seeing a bit of stabilization come through. Looking at the manufacturing sectors for the key economies, the US and China here, green and blue, while they've been flipping around the level of the baseline here, which effectively shows no growth. If you see anything below 50, it implies a little bit of a pullback. Above 50 means a bit of growth. Both of the US and China have been mostly around baseline, if not a little bit stronger for what we've seen over the last year. But the Eurozone has clearly been sitting below that 50 baseline, implying a sustained recession in their manufacturing sector over the last 3 years. But now, given from the beginning of the year, we have seen a significant easing of those pressures and a move now very close to the baseline, which suggests to us that the Eurozone might be able to crack back at least to a stable growth in their manufacturing sector, if not a little bit of recovery going forward. You'll often hear quite a lot of issues around the risk of supply chain disruptions, given how the conflict zones are, the tensions are flipping back and forth and flaring up at times. But while the rhetoric can be quite concerning, if you look at the data here compiled by the Federal Reserve of New York, you can see that in terms of how they measure pressure in the global supply chain. So this is in effect a negative graph. If you see something positive here, it means there's more pressure in the global supply chain. if you see anything on the negative side of the graph, that suggests things are improving in general. And most points from the last year or so, despite everything we've seen around Ukraine and Russia and the intense worries around Israel and the various conflicts that are enveloping it, we are seeing a general tendency towards those global supply chain pressures easing. And most importantly for PGMs, we are also seeing in the overall data an improvement in global car sales. When we last spoke about September last year, we had noted that we saw a bit of a flat line in that growth, and we were worried that it might slow down further if interest rates don't really start to move and sentiment can pick up. But we are seeing a little bit of a general trend upwards in global vehicle sales alongside everything else that's pushing into the platinum space at the moment. So I'll leave it at that point to turn to more of the PGM specific commodity trends to see what's been happening there.
Hello, everyone. My name is Vinesh Chetty. I'm the head of research here at Afriforesight, and I'll be taking us through some of the demand for PGMs. Specifically, we're going to be looking at two main centers, being cars and industrial demand, including hydrogen. And just before we get into that, I'll remind you, please, if you have any questions, go right ahead and type them in the Q&A, please. And we'll get to as many of them as we can at the end of the presentation. As I said, cars and industrial are going to be the two main factors we look at, and we're going to start up here with the car market. Now, I'm sure many of you have been hearing about those electric vehicles that are gaining market share, and they absolutely are, but it's worth looking at things in context. So down at the bottom of this graph here, you see the light green being petrol-powered cars, and in 2024, 70% of new cars sold were petrol-powered, versus only about 10% being battery electric vehicles. So yes, EVs are absolutely gaining market share, but it's worth remembering that still today and into the future, we expect most new cars are still going to be sold with petrol engines in them. And these are just the sales. So there are still a lot of petrol-powered cars that have been sold over the decades on the road. But certainly there is a shift towards electric vehicles. And you'll notice here that we're actually talking about two different kinds of electric vehicles. In the yellow, you have the battery electric vehicles. These are your EVs that only have electric motors. They don't have any sort of engine in them. The only way you can drive these is by charging the battery up and then driving them. Whereas we have here a plug-in hybrid electric. These kinds of cars have batteries that you can charge by plugging them in, but they also have petrol engines which allow you to drive the car as you would drive a petrol-powered car. Now, you might ask, why would you need both? It's consumer preference. A lot of consumers have what's called range anxiety. They have a concern that if they drive an electric car, they'll get stuck somewhere that they can't easily recharge it, that the relatively short distances between recharges are a problem for them. So many consumers are choosing plug-in hybrid vehicles. And a good example of this is Toyota's sales. Toyota is the world's largest car maker. And in May, 40% of Toyota sales worldwide were hybrid cars. So of all the cars they sold, 40% of them were specifically these plug-in hybrid vehicles. So it's showing you that consumers want these vehicles, and a company like Toyota specifically is leaning heavily into producing these vehicles. Now, what does all of this have to do with PGMs? Well, PGMs are used as auto catalysts. They are used in the exhaust system of cars, and they help to create a cleaner environment. They help to remove carbon monoxide and nitrous oxide compounds. When you look at the different PGMs, though, you'll see that while platinum up here has about a balanced demand between automotive autocatalysts and other industrial sectors, whereas your palladium and your rhodium are overwhelmingly tied into the car market. Now, what about South Africa itself? Well, when you look at where South Africa sells its PGMs to, we overwhelmingly send them to regions that make cars. You'll see these 5 big regions here: the US, Japan, the UK, China, and Germany. That's where South Africa sends the vast majority of its PGMs to, and those are your big car-making regions. Now, as I said, there is a shift towards hybrids and battery electrics, and the hybrids present a good growth for PGMs because they have PGMs in their autocatalysts as opposed to a battery electric. But also due to the nature of those vehicles, the hybrids often turn their petrol engines on and off multiple times during the day, and that tends to require more PGMs in the exhaust system to keep the air clean. So with companies like Toyota and Ford leaning heavily into hybrids, that can be growth in demand for PGMs. What's also pushing PGM demand, even in traditional petrol-powered cars, are increasing emission standards. We have countries, China, the UK, and others, increasing their emission standards, tightening them. And as part of meeting those tighter emission standards, car makers are adding more PGMs into their exhaust systems. So South Africa sells its PGMs mainly to car makers, and we see car makers continuing to use PGMs and potentially increasing the amount of PGMs loaded per car. But what about on the new energy vehicles, the hydrogen power and the battery power? Well, when we look at where those vehicles are sold, overwhelmingly, China is the main market to watch. You see here in the light green, China is the place where most new energy vehicles are sold, and most of those are battery powered, but there is also room for things like hybrids and hydrogen. Now, you'll notice that generally these NEV sales have increased in the last 4 years, but there was a decrease at the beginning of 2025. Now, what was this about? A lot of that was the economic weakness that Nathan talked about, but some of it was also the change in subsidies. The governments around the world were often granting large cash subsidies, trying to encourage people to buy battery electric vehicles and the like. And with those subsidies ending and being reduced, that's decreased people's preference for buying electric vehicles. And for those of you who've been following the news just this morning on the US budget, the new US budget, or as President Trump calls it, the one big beautiful bill, it calls to end EV subsidies in the United States. So that will, again, likely push down on demand for these battery electrics. But overwhelmingly, China is the main market to look at. In fact, in China, in a given month, about half of the cars sold in China are new energy vehicles. Chinese car makers tend to dominate the manufacture of these vehicles. Many of these cars being sold in Europe were either built completely in China or even have components built in China, because Chinese companies tend to dominate the marketplace for building batteries as well as electric vehicles. But as I said at the beginning, PGMs also have a demand center on the industrial side of things. Those battery electric vehicles work well or can work well for private users, but they often face problems in industrial settings. As I said, those long charging times, they can be annoying to private car drivers, but when you're trying to move truckloads of goods cross country, those can often be unbearable. So we're seeing a preference for hydrogen fuel cells in the commercial space. These also tend to have much better towing ability than electric vehicles, which can often use up their batteries rapidly when towing. So those hydrogen fuel cells we see working well for things like trains, buses, heavy trucks, and particularly in Asia, we're seeing a lot of companies looking to build out fuel cell vehicles. What does this mean for PGMs? Well, the big thing with hydrogen is that PGMs are also used in the hydrogen space. PGMs are used as catalysts in electrolyzers. And in simple terms, an electrolyzer is a machine that makes hydrogen. So as the world uses more hydrogen, there'll also be more PGMs needed for those electrolyzers. And while hydrogen can be used directly in fuel cell vehicles, hydrogen also has uses in other industrial settings, particularly to make synthetic fuels to replace traditional oil-based fuels in cars, in heating systems, and for jet fuel, and even for shipping around the world. So as the world continues to shift towards cleaner energy, hydrogen has a place to play there, and PGMs have, we see increasing demand for PGMs, both in hydrogen and in those hybrid vehicles. So for more on hydrogen and PGMs, I'll hand you over to Kirsi, but please, if you have any questions, do type those in the chat and we'll get to them soon.
Thanks, Vinesh. So currently the hydrogen economy makes up about 2% of platinum demand and is expected to gradually rise as some regions encourage green hydrogen use due to tightening emission standards. Most hydrogen is currently produced by fossil fuels, and the shift to green hydrogen technology requires PGM catalysts used in electrolyzers. But some PGM miners like Sibanye-Stillwater invested in studies to determine if palladium could be used as a catalyst, where we see platinum is the main catalyst at the moment. So this could lead to more demand for palladium. Green hydrogen production should be encouraged, and that's mainly as used for a feedstock in chemical making and to produce more environmentally friendly fertilizers and fuels. The fuel cell vehicles, however, are expected to remain a small portion of green hydrogen demand, with their uptake being held back by a lack of hydrogen refueling infrastructure, as hydrogen is difficult and energy intensive to store and move around. So let's look at the direct impact some of the main demand drivers have on PGMs. Platinum and rhodium demand is expected to rise over the period due to higher hybrid and petrol vehicle sales. However, palladium demand from the automotive sector should decline as some automakers, especially in the US and the EU, are voluntarily reducing purchases from Russia. Some of the automakers also prefer using rhodium instead of palladium due to it being about 7 times more effective as an autocatalyst. While the automotive sector is the main demand driver for PGMs, they do have other uses, especially platinum. Industrial demand is expected to remain constrained in 2025 amid weaker consumer demand and global growth concerns. One of the main industrial sectors is glass making, which mainly uses platinum and rhodium catalysts. Glass making should be held back this year as very few new capacity additions are expected to come online, mainly in China. Demand for glass is also expected to remain constrained amid China's weak property sector, with construction activity down 10% in the first 5 months of 2025 compared to the same period last year. Jewelry demand should increase over the period as the gold price remains elevated and some consumers, mainly in Asia, prefer the cheaper platinum. Due to generally rising demand, PGM miners are expected to ramp up their production. And South Africa is the major producer. We produce about 70% of platinum, over 80% of rhodium, and South Africa is second to Russia with 38% of palladium production. So South African production should remain constrained in 2025 amid the cost-cutting measures that was put in place in 2024, which was implemented by most PGM miners, including Sibanye-Stillwater, Impala Platinum, and Anglo-American Platinum, which is now known as Valterra Platinum. The cost-cutting measures included job cuts, putting expansion plans on hold, deferring investments, and putting smelters on care and maintenance. Mine supply should rise from 2026 as some investments and expansion plans are expected to restart, and PGM basket prices are expected to rise, and mine level profitability should improve. Refined production should remain stable amid the absence of power curtailments and as some miners process ores out of existing stockpiles. Russia is the second largest PGM producer and the largest palladium producer, with most of its production coming out of non-nickel. Output is expected to increase amid completion of non-nickel smelter maintenance in late 2024. Production is also expected to continue ramping up through the period, despite some of those EU and US consumers moving away from buying Russian metals, as most of non-nickel's production is being sold to Asia, mainly China. In the US, the largest PGM miner is Sibanye-Stillwater. 2025 production should decline as Sibanye plans to suspend mining at the Stillwater West mine and deferred spending at the Stillwater East Boulder mine. However, despite increases in PGM basket prices, we still expect the Stillwater West mine to continue ramping down production as the Stillwater mining complex is a higher cost mine. The Stillwater mines are also palladium dominant, And despite the palladium price being elevated currently, we do expect the price to decline over the period, which weakens the Stillwater mine's operational level profitability. But focusing in a bit more on South Africa's PGM miners, an increase in mine level profitability is expected due to higher PGM basket prices currently and cost-cutting measures from last year, which are mostly still in place. The cost curve for the second half of 2024 shows the average 6E PGM basket price as the red line and the main PGM miners' operational costs on the y-axis. The costs were below the basket price for most of the miners, and they remained cash positive and maintained operational level profitability, which should increase in 2025 as this basket price is now higher than it was last year. The EBITDA margins were still positive in the second half of 2024 for some miners, such as Amplats and Sibanye-Stillwater. But despite this operational profitability, PGM miners still have some of the highest capital costs, and this would make it difficult to build an investment case for a greenfield PGM mine development. But due to supply concerns, such as platinum being expected to be in a supply deficit in 2025, we should expect some sustained development in South African PGM mines to meet the rising PGM demand. We see this as some miners are continuing to develop their mines, such as Wesizwe's Bakobang mine that started trial production last month and is focused on maintaining steady operations and optimizing performance. And work on Ivanplat's Platreef mine is ongoing. Phase 1 production is expected in the fourth quarter of 2025, and Phase 2 expansions planned for 2027. So what does this mean for prices? Platinum prices are expected to remain elevated in the third quarter of 2025 due to increased investment demand as platinum ETFs remains elevated and on higher jewellery demand. The expectation of platinum supply deficit in 2025 should also place upwards pressure on prices. Prices are expected to generally trend upwards throughout the period as plug-in hybrid vehicle sales rise and petrol vehicle demand is sustained alongside gradual growth of the hydrogen economy. Rhodium prices are expected to gradually increase following a similar trend to platinum as emission standards increase. Automakers should use higher loadings of rhodium despite its higher price level to combat these exhaust emissions. Palladium prices should remain relatively elevated amid some investment demand initially, but should gradually decline over the period as some substitution with rhodium places downward pressure on automotive demand for palladium, and palladium prices should also face downward pressure as Russian production continues to rise. So that ends our formal part of the presentation. Let us move on to the question and answers.
I see I've got a question here specifically related to the hydrogen or hydrogen engines. So Toyota has recently come out with news that they've made a breakthrough in this regard. I mean, the question is now on cost effectiveness. You know, is what they're looking at. I mean, from the little that we've touched on so far, maybe not quite so in the near term, but potentially as the the technology takes more hold, the increase in the markets can push down the cost of that. But what are your perspectives there on how cost effective the hydrogen engine might be, and would that necessarily be the prime driver of platinum, or how much of an impact do you think that might be there, Kirti?
Okay, so yes, Toyota as well as Hyundai and a few South Korean car makers are developing more efficient hydrogen engines. The problem with the hydrogen vehicle demand is that the fueling infrastructure is not where it needs to be to support these cars on the road. Many of these countries don't have enough hydrogen refueling stations. The cost of hydrogen as well is quite high as a clean fuel. So that sort of reduces demand for a hydrogen vehicle. Whereas with Toyota, they are trying to make the vehicles themselves cheaper and run more efficiently on hydrogen.
Thank you. Right. bit of a high-level question for South Africa itself that I think, Vinesh, you could maybe step into. How do South Africa's port and energy infrastructure challenges impact operations, if at all, and the potential for exports in this context?
Sure. So on the raw PGMs themselves, it's relatively low. The South African PGM, the actual metal is flown out of the country for the most part. There are minor issues like getting equipment in and out. You know, the PGM miners are still affected by bringing machinery in, but for actually exporting the PGMs themselves, it's relatively a small issue on ports. I would say though, electricity is a major factor when it comes to PGM mining and even smelting. It is difficult to keep people safe kilometers underground. We have seen issues when there's heavy or high stage load shedding. The PGM miners can reduce shifts, can choose to keep the people above the surface. And smelting PGMs also uses a lot of electricity. So certainly the electricity side of things is a major factor. And on ports, getting equipment in can also be a factor.
Okay. To take us a little bit out of the shorter term context that we've been talking about, the question is quite right that, if you're looking at proper mine investment, you would want to look at a medium, if not a longer term outlook there. If you could maybe just extend your thoughts maybe to our 5-year outlook for the PGMs in general. Do you see a significant shift or other trends coming into play a bit later in our medium term that could shift these trends or push the various PGMs in different directions as we go forward? You're still muted there, Kirti.
Yes, sorry. Yeah, so the platinum price and the palladium price, we expect platinum to still remain volatile, but generally trend upwards in our 5-year outlook. And the reason for that is we still see some sustained petrol demand, or petrol vehicle demand in the next 2 to 3 years. And then we see the rising sales of plug-in hybrids and mild hybrid vehicles, which require more PGMs than petrol and diesel does. We also, even though the EV transition is still taking place and full battery electrics should gain market share, the hybrid sales should rise faster than battery electric sales. So that pushes up on our PGMs, and we still have industrial demand, and we expect as global growth should improve over the 5-year outlook, we should see more industrial demand for platinum as well. Rhodium prices are also following similar trends to platinum and rising. Especially as emission standards are tightening mainly in Europe and Asia. We should see more rhodium being used in vehicles because of its better ability to combat these harmful emissions, especially the NOx gases, the nitrous oxides. And palladium, however, is odd one out, where the palladium price is expected to continue declining, and that's on some substitution from the rhodium, but also as palladium is just in the near term mainly mined in Russia, and some producers in the US and the EU are moving away from Russian metals. But we see that palladium also has the issue of it is not commonly used in industry as well, where glass making and chemical making prefers to use platinum and rhodium. So palladium falls short there in terms of demand.
Okay, thank you very much. Right, got a little bit of a byproduct question here coming through from the impact on chrome in the PGM sector. And, is there potential to sort of save a marginal PGM mine? And, we've heard some anecdotal evidence, and we've seen some support that did come through in sort of the worst of times. Looking at last year, maybe a little bit of the year previously, when we saw that quite a sharp collapse in the profitability outlook for the sector, and then them having to turn around to battle costs. The fact that in that context we saw a general quite a strong rise, in fact, in the price of chrome ore, which is a byproduct for many of the mines, especially if they operate in the UG2 complex. That did in fact help to support and maintain certain players in the market. There's a little bit less support at the current level of the price. We have seen a bit of a pullback in that level, but yes, I do think that if they are completely on the margin, that it can be some support, but I would much more look into where we're looking at it at the platinum, maybe the platinum and palladium combined as the various factors. So the core thesis here, I think, is mainly that the platinum price is expected to trend up. That will really save a long-term investment here rather than the chrome. But in the near term, if they're already going, I do think that will help to sustain things. Yes. So let's see who's next here. Okay, well, this is a very near-term thing. I mean, we obviously had a very sharp increase within the recent weeks in platinum particularly, and just trying to hone in a bit on that. Now, Kirti, you can step in if you want to add some detail here, but as we were watching the markets, the most recent trigger and what has caused the sharpest increase within the last couple of weeks is the sight on the platinum supply deficit. Once the largest industry body, the World Platinum Council, came out to give their outlooks and the state of the industry as reported to them, it was distinctly shown that there's going to be a deficit, maybe a little bit of a rising deficit, a sustained one, and more perception on that is really what has driven the spike in platinum prices, particularly in the last few weeks. But that also came in with the context of a weaker dollar, still relatively strong demand from the jewellery side of things, and some lingering improved sentiment after those recent changes in car maker plans. Some of those changes in Toyota, and I think Isuzu maybe also said that they're going to come through and push for more hybrids in around May. So all of those factors pushed into June and combined in a short space to really push up that price. But the most recent and sharpest indicator was the sight of what's actually happened to South Africa's production. We look at the overall trends here, but we did have quite a sharp seasonal pullback in the first quarter figures, just based on the nature of how wet it was. We saw some floodings and whatnot, and certainly some slowdowns on the mining side, and that has impacted the actual refined output at the end of the day for the near term. But that is not expected to be a long-term factor necessarily, and that's part of why we do see a bit of a correction in the platinum price in the next couple of quarters, even if it remains relatively elevated. You did mention a couple of new developments there. Are there any, other new mines beyond the Bakubang or that Ivan Plat's idea that you were talking about, or are there an overall decline that we should still be expecting, even if we do see those expansions or newer ideas coming through?
I wouldn't say there would be an overall decline, but we expect PGM mined PGM levels should still increase. In South Africa, besides those two mentioned mines, there is also the Waterberg mine owned by the Platinum Group Metals Company that is planning to start production in the second half of 2029. And there's also the Bengwenyama project by Southern Palladium, which also aims to start before 2030. So those are two new mines starting production, and then we also see increasing production and ramp-ups and expansion plans from our big three miners, which is Impala Platinum, Valterra Platinum, and Sibanye Stillwater.
Thank you very much. We did touch a little bit on the infrastructure side, but I know this is a little bit more of a pointed question here, Vinesh. Now, we obviously do have energy constraints here in South Africa. It's been less impactful in terms of the load shedding we've known over the last decade. But how does that actually pull through to affect PGM production, and what sort of global impact could you expect if something like that would return, sincerely?
So it certainly can affect global production. As we've seen, South Africa is the largest producer of platinum, the largest producer by far of rhodium, and a pretty significant second largest producer of palladium. And when we've seen particularly high level, the levels above stage 4, the 5s and 6s of load shedding, we've seen PGM miners not send their staff underground. We've seen actual production reductions. So it certainly can affect it. If there was an increase in heavy load shedding, that would probably reduce the amount of supply available. particularly of refined product, because we have seen the smelters operate less as well when there is high-level load shedding. So the other main factor is it raises the cost base. That because we have so much load shedding, because Eskom has so much debt, they have been asking for above inflation level increases for years. So that increases the cost of being a PGM mine in South Africa compared to being a mine in another country. So you've got this unreliable, or not as reliable as you'd want, electricity supply and relatively expensive electricity. So it keeps costs high, and it can push down on the amount of PGMs extracted in South Africa.
Oh, thank you. There are a few questions here. Maybe I'll leave this one for a little bit later. It's to do with politics. But Kirti, what impact could recycling have? I mean, we don't typically look too directly at that. We study more the mine supply side of things. But supply, I mean, recycle supply for each of the three metals, as your graph showed earlier, is significant in all factors there. Is there any scope for that to offset some of what you're saying in terms of trends, or but all the question is actually specifically in 2025. Have you seen anything in terms of recycling shifts this year?
Okay, so recycling does contribute to overall supply in the world, and it does push down on PGM prices. However, in 2025, we don't see so much of that downwards pressure from recycling because recycling levels have been lower. So what that means is fewer people are turning in their old cars for recycling, and especially due to the global growth concerns and economic concerns in the world right now, people are holding on to their old cars for longer. We see this as car sales in the first quarter was also weaker in some regions, which meant people didn't buy new cars. They just kept the older cars that they had. And cars that are older, like 20 to 15 years old, had lower amounts of PGMs than the cars of today. So even with recycling cars in 2025, the amount of PGMs that are going back into the market is not as high or not significant enough to push down on those prices for us to see like a price decline because of recycling.
Oh, thank you very much. Right. I mean, you mentioned quite a few times, and we've been noting this obviously over the years, but the costs side of things was a significant concern, certainly last year and the year before. A little bit better right now, given where the prices are. But have you noticed, or have the miners themselves said anything about trying to improve their transport efficiency within their operations, and particularly the open pit side of things? We don't really have very many open pit operations left, right? I mean, outside of the Amplat's newer development, I can't think of one offhand. But Kirti, is there anything that you've seen there in terms of trying to address efficiency in that to get more of that cost base under control?
So in recent years, we did see Anglo American Platinum try to use or test a hydrogen-powered haul vehicle, a truck for underground mining, though. They did say that the trial was successful. However, we are still yet to see miners adopt hydrogen trucks or electric-powered trucks. They have been trials at multiple other miners across the world and even in South Africa, where they try to use electric trucks, hydrogen vehicles, and yeah, I wouldn't say there would be a large scale adoption of electric vehicles in this year or the next year, but we should see more of these trials start up and more miners try to test if these are efficient ways to lower their costs. At the moment in South Africa, running a hydrogen vehicle is more expensive, and it is more difficult in terms of that these miners would need hydrogen production or hydrogen storage facility on their mine site. These hydrogen dispensaries are not readily available. So we would need the miners to put some capital investment into hydrogen storage infrastructure or electric charging infrastructure to be able to run these trucks on their site. So that does involve an initial cost to then lower transport costs. So we don't see any major shifts happening in the next year or two.
Okay. And just a final question here, I believe. I don't see anything else waiting here. Yes. Okay, so you obviously mentioned that Russia is a big part of at least the palladium basket in terms of supply, but in general, they are the second biggest producer. And given how their conflict with Russia has strained, or in some places almost destroyed, relations with mainly the Western partners, if we do see a ceasefire or a sudden end to that conflict, do you foresee any significant change in the supply dynamics or the demand dynamics from what you've picked up so far over the next year or so?
Okay, so I don't think there would be a sudden shift back into everyone starting to use Russian metals. Usually shifting an autocatalyst chemistry to being more platinum or rhodium dominant does happen over time. And since the war has started, I think 3 years now, they've been automakers have already been in the process of shifting their autocatalysts to be more platinum and rhodium dominant to move away from palladium. So it should take around that amount of time to shift back into more palladium dominant catalysts. And we may see that in future, especially as the palladium prices are expected to decline. The automakers might start to perform a cheaper autocatalyst, so they may move into palladium again. South Africa does have significant palladium supply, and we're a good option to source palladium, but Russia is over 40% of global supply, and that is very hard to replace. So if automakers decide to use palladium again, Russia is their option to get palladium. If the war had to suddenly end, it would be a gradual shift back into using Russian metals. That's also on the political side, assuming that these Western countries can sort of heal their relationship with Russia. It's usually more complicated than just the simple, we need palladium and we shall buy it. However, Russia has not been suffering in terms of their PGM sales. Asia, more particularly China, willingly buys Russian palladium, platinum, and rhodium, and have been doing it for a while. So we should see Russian production still increase, despite the Western countries willing to buy it or not.
Okay. Thank you very much. Right, that's now us running through all the various questions. Like I said before, if you do come up with anything else turns up to you, you're more than welcome to give us a call or shoot us a mail, and we'll be very happy to get back to you with any answers we have. But for our last part, just saying thank you again for joining us, and hope you have a great day further.